the subject of personal financial management, personal financial decision rather, I'll be talking about investment decision process. In my last lecture on investment decision, I talked about what is investment, the different types of investment in the sense that financial investment, real investment, means financial assets, real assets, what are the factors which will consider while investing. And today's lecture I'll be talking about what is the process of investing, how you move normally. So I have divided in 6 broad categories of the process of investment decision. The very first thing what you should do or what we do in our life is that we decide about the investment policy. Right? I'll be talking of these things in setting up an investment policy, then building up an inventory of securities, portfolio security analysis, portfolio construction, portfolio performance evaluation and management, and finally portfolio revision. So broadly there are 6 different steps or 6 steps which are involved in any decision making, any investment decision making process. I'll be talking these steps one by one. The very first thing is, what is investment policy? What we do at this stage? First of all, while making any investment, we must be clear about what our goal is, why we are investing, what we want to achieve. Each one of us has financial goals. I have talked in my previous lectures on personal financial planning in detail about your financial goals. There can be different goals in life for making any investment. You are a young person of 20-25 years. You want to make investment so that by the time you will retire, you should have accumulate enough wealth so that you at an age when you are not able to earn, you can have your personal needs satisfied without any financial trouble. Or you may be having 5 years down the line, you want to buy a car, right? That may be your goal. So each one of us has different goals at different point of time, and we may be having simultaneously also all these different goals. So make your financial goals, make your investment goals very clear, what you want to achieve by making this investment. What are your objectives of making the investment, right? I want to have a big house. So I am investing that for a period of 10 years, that after 10 years, I want to buy a bigger house. I am living in a small house. I want to convert this smaller house into a big house. So I will dispose of my old house, that is in the house in which I am living, and I will buy another one, right? So for which I will be requiring a reasonable sum of money. If this is my goal, this is my objective, then my investment horizon is 10 years, right? So you have to decide what your goal is. What is your investment horizon? Means for how long or what is the period for which you want to make investment. That is called investment horizon. How much funds you have depending on your income, depending your expenditure, because each one of us has different level of income. Each one of us has different expenditure, means family expenditure, monthly expenditure, your personal needs, right? So depending on how much you can save, because you will able to invest only that money which you will able to save, right? So how much investable funds you have, and the tax bracket in which you lies, your income lies rather. There are certain people who are in the higher tax bracket who has to pay the highest rate of tax. Then there are certain securities which gives tax concessions that if you dispose of those assets, those whether real asset or the financial assets, there are less burden of tax. There are certain people whose income is not taxable at all. For them, they may be investing in any of the asset which gives them highest return with safety, that will give them the satisfaction, because there is whatever the income that will be generated by that investment is not subject to tax, because their income doesn't lies in the taxable income bracket. So what is your tax bracket, what is your time period for which you are investing, what is your goals, how much funds you have, this is very important. You should be very clear in your mind that this is my investment policy, investment process, deciding about the investment process. You have to decide your investment policy depending on these things. So there can be different objectives as per risk return preference of the investors. You might have come across many people in life who always argues that they don't want to take risk. Even if the return is low, they are happy with it. So these type of people prefer bank fixed deposit. These type of people prefer to deposit in the post office. They prefer in the, if they are the senior citizens saving schemes, and so on and so forth. I'll be talking all these different investable securities that are available in detail in my next lecture. But at the moment I'm saying, depending on your risk and return profile, you will make an investment decision. So whole idea is, first you should be very clear, and I tell you with my own experience in life that most of us do not make this investment policy. We are not clear what we want to achieve by this investment. We just, whatever we are saving, we just invest it, so that if you ask anybody, they will say, we want to create wealth. I mean, what, everybody want to create a wealth, but for what purpose? How long you want to invest? What is your investable funds? That will decide. Many people, as a financial consultant, people will ask you that I want to make some good investment. So you tell me the investment which gives me a good return. See, this definition of good return is a very subjective term, because it depends on your risk profile. If you are ready to take higher risk, when I say the risk, means variability of the return. There are certain asset classes, there are certain investment which can give you high return, but they are risky. There is a likelihood that you may even lose the capital, not to talk of return. And there are certain assets, there are certain financial securities which gives you very low return, but they are 100% safe. Say, if you want to, just to give an example, if you are buying a government bonds, government treasuries, government securities, they give you comparatively lesser rate of interest as compared to the private companies, securities or other assets, but they are very safe. So depending on your risk profile, you will make your investment policy. So these are the few things, means your financial goals, your investment goals, how much fund you have, in what tax bracket your income lies, and your investment horizon, means the period for which you want to invest, because different people have all these aspects differently. So depending on that, you will make your investment policy. The second step is building up an inventory of securities. When I use the word building up an inventory of securities, means there are plethora of securities, financial assets and real assets in which you can invest. At least one should know that which are the financial instruments, which are the real assets which are available for investment. Again, your selection of securities will depend on the first point which I discussed just now, depending on your time horizon, depending on your tax bracket, depending on your risk profile, depending on your goal you want to achieve. But we must know that these are the available securities, these are the which are available for investment. Again, what we will select, that is a later story. But at least we should know, because unless we know, because many of the things we do not know. So where you will invest? So decision making is always based on information. If you do not have the requisite information, how will you take the right decision? So for taking the right investment decision, it is important to know that which are the securities which are available to you. So a list of available securities where the investor can make his investment, it has to be prepared. I am not dealing with the securities, I am not discussing the securities at the moment, because I will be talking in detail when I will be talking of the different financial assets, different financial securities which are there. Just to name, you can invest in equity shares, you can invest in mutual funds, you can invest in derivative market, you can invest in bank fixed deposit, you can invest in government bonds, you can invest in private companies bonds. So there are fixed income securities, there are variable income securities, you can invest in gold, real estate, and so on and so forth. So there are different type of securities which are available. You should know that what is the pros and cons of each of the securities, each of the investment, each of the asset, right? And then you will take a wise decision. Depending on your investment objectives, as I just said, and the horizon means period for which you want to invest, the securities are filtered based on security analysis. Means, as I said, each of the security has its own merits and demerits depending on your objective, depending on your period of investment depending on your risk profile. So I'll be talking in detail about the different type of security. At the moment I'm saying at least the thing is that we should know that these are the different asset classes in which we can invest. So performing means then the next step involved is performing security analysis. When you talk of the performing security analysis, means we have to analyze the pros and cons of investing of each of the securities. What is the benefits that will be accrued to you in terms of regular income, in terms of capital gain. When I use the word capital gain, what it means is that when you will dispose of this asset, the amount of profit oblique the loss. If it is a loss, we call it capital loss. If it is a profit, we will say it is a capital gain, right? So whether you will, what type of or what amount of capital gain or capital loss you are expecting, right? So you analyze each of these securities on the base of your expected profits, your regular income. Like many people argues that gold is a good form of investment. It is a hedge against inflation over a period of time. It has given a return which is higher than the inflation rate in world over. But gold doesn't give you a regular flow of income. If you buy gold in physical form and keep in your almirahs, over a period of time the price of gold increases, but it does not give you a regular flow of income. On the other hand, if you invest in equity market, right, that can give you income in the form of dividends, not to talk of the capital gain when you will dispose it off or the loss. But there is a risk element that there may be a loss also. You buy a share at the rate of ₹100 per share, and after 2 years it may be 80 rupees, it may be 70 rupees, it may be 200 rupees. So that is the risk is there. So on the basis of the different parameters of which we have talked quite often about risk, about expected return, about the period for which we are investing, right? You have to analyze each of the securities. Like for example, when we talk of the real estate means you are buying a commercial property just for investment purposes. So when you are buying a commercial property, normally these type of investments are for a longer period of time, because the expenses involved in transaction, buying and selling and all these things, right? Government papers, taxation is quite burdensome, is quite heavy amount. So it's not a wise decision to buy real estate for a very shorter period of time. When your horizon is for a longer period of time, then only one should think of the investing in the real estate. So it means each of the security, right, must be analyzed on the basis of the different factors. And broadly, if I talk in terms of the two factors, I'll say fundamental analysis and technical analysis. And normally when we talk of the fundamental analysis and technical, more of it is being used for the equity market. Fundamental analysis means the finding out the real value of that asset, right? And real value means the worth of the asset. There are many factors on the basis of which we decide that this is the fundamental value of an asset, and if the prevailing price in the market is less than what you feel is the fundamental value or is the basic value of the asset, one always tends to buy it, right? So you make a fundamental analysis. And technical analysis. Technical analysis is for a short period of time. Normally, technical analysts analyze the past behavior of that asset, means the price behavior of that asset, and on the basis of that, they find out that what will be the future price trend in that asset. Suppose if I talk of gold, if the gold prices are rising, if there is a momentum increase in the gold prices for a quite substantial period of time, the gold prices has been static, say for example, and now the gold prices have start rising. What you do is, the people who want to invest in gold, they will see the data of the last 10 years, 5 years, 2 years, 3 years, depending on the horizon for which you want to make investment. And you will check what is the price behavior of the gold. What is the price behavior means the market price of the gold. And on the basis of that, means by analyzing the past, you will like to predict the future price of the gold. So that is what the technical analysis do, right? So you make fundamental analysis, you make technical analysis, and then you find out that whether this is the right time to invest or not. So technical analysis, and this efficient market hypothesis presumes that whatever the price that is prevailing in the market, it is reflective of all the information that is available for the securities, right? So each of the asset, the short point is that each of the asset must be analyzed on the basis of its merits and demerits, means on the basis of its fundamental value, technical value, and whether it is the right time to buy or not. Then comes portfolio construction. When I talk of portfolio, portfolio means bouquet. You have different flowers in the bouquet. Similarly, you have different type of securities in your portfolio. Just to talk in raw sense, I would say that you must have basket of asset class, some in form of gold, some in form of bank fixed deposit, some in form of post office deposits, some in form of the equity shares, some in form of debentures. Like I have named only 4, 5, 6, right? It is a bouquet of these different investments, these different securities in which you can invest. Each has its own rate of return, each has its own risk profile. We say bank FD. Why do people go for the bank FD? Why do people go for the post office deposit? Why do people go for the deposits in PPF or PF? The first thing that comes in our mind is that it is a very safe investment, right? You will able to protect your capital. I'm not considering inflation, but keeping apart the inflation, you will able to protect your capital. You know it, that whatever you are giving to the government of India, it is 100% safe. Government of India has never failed, at least for the retail investors in the past, in paying out its obligation, right? So you presume it that it's a safe investment. So some part of your investment you want to keep in some safe securities which are 100% safe, but nevertheless it gives you, as compared to many other securities, lesser rate of return because the risk is low. On the other hand, if you are investing in equity market, and even in the equity market there are different classes of shares. There are certain blue chip companies. Blue chip companies are those companies which is having shares of very large company, reputed company. They may not give you phenomenal return, but they give you static return which is certainly higher than the bank FD over a period of time, long run. I'm not talking of the short run, 5 years, 7 years, 10 years down the line, right? There are certain securities which we call it small cap in the language of the equity market, stock market language. Small cap means the companies, the shares of small companies. They can be multi-bagger. They can give you phenomenal return. They can be double, triple, but it is very risky. They can just become half also. You can become 20% also, because the likelihood of success of the company and the failure of the company both is very high. The some company succeed and some company fails. If company fails, the 10 rupee share may become 0. If it succeeds, 10 rupee share may become 100 rupee. It means that even within the equity market, there are different classes of shares, different types of shares, different industries are there, right? So, what you have to do is, you have to create a portfolio. Portfolio, what do you mean by portfolio? Portfolio means a basket of a combination of various securities. When I say 2 or more securities, in which an investor may prefer to hold investments. So after security analysis, which we discussed in a previous point, right, then investor construct all possible portfolio and select the optimal portfolio. Friends, at this moment, because it is subject of personal financial planning, I am not discussing optimum portfolio, but in my previous lectures on investment decision or on portfolio analysis, I have discussed a lot about what is optimal portfolio. So optimal portfolio is that portfolio with a given degree of risk can give you maximum return. And what is the degree of risk which you are ready to pay depends on individual to individual. So at a given risk profile or at a given degree of risk, the return which gives you a investment which gives you maximum return is called optimal portfolio. So what we do while constructing the portfolio is that on the base of our risk profile, on the base of our time horizon, we construct such portfolio which is optimal portfolio. And what is optimal portfolio? It depends on individual to individual. right? Because there are many factors which are being affected while making which affects the investment decision of a portfolio, or while constructing a portfolio, right? While you are making a portfolio, there are many things which you will consider. On the base of that, you will decide that what is the optimal portfolio. The sum total is, the main moot point is that you have to create a basket of securities. Don't invest always in one securities, because it may clicks, it may not clicks, right? So for selecting the optimal portfolio, we need to consider the risk return preference of the investor. I have already spoken about it. Next is performing portfolio performance evaluation. What do you mean by portfolio performance evaluation? What it means is that you evaluate your portfolio which you have constructed, not on day-to-day basis, but at some regular intervals, keeping in mind the environment, keeping in mind the changes in the environment, right? We say the environment is VUCA, it is volatile, right? It is uncertain, it is complex, it is ambiguous. So there are many things which are beyond your control, which affects your value of your portfolio. So on a regular basis, when I am using the word regular, it doesn't mean on a day-to-day basis, but at regular intervals, one must evaluate the performance of the portfolio. When I say evaluate the performance, what it means is that whether this portfolio is giving you right amount or right percentage of return which you expect, or the different assets which you have created in your portfolio, in your bouquet of investments, which are giving you good return, which are not giving you good return, right? So the assets which are giving you good return, you will continue to invest with that. And the assets which are not giving you good return or which are not performing, you may like to change it, right? If I find that this equity share is not performing, the company is making losses and these losses are increasing, so it means there is a lesser likelihood that the share of this company will perform or will increase in future in the stock market. So what you will do is that you would like to get rid of that share and buy some other shares where the performance of the company is doing well. What it means is that periodically you must analyze your portfolio, keeping in mind the benchmark return, either your own return or some benchmark return which you set for yourself, right? Suppose if I am investing in the mutual fund, and I have invested in the mutual fund also, there are a whole host of schemes. I have invested in a scheme where the mutual fund house or the asset management company invest in large equity shares, means large cap shares. So when the large cap shares, so there is a benchmark called Nifty 100, where the 100 top companies of the stock market, which are listed in the National Stock Exchange, they are being quoted. So you will compare your mutual fund with that, and on the base of that you will see that whether your scheme, whether your mutual fund is your scheme in which you have invested is performing well or not, right? So there are some I want that my portfolio must give me 12% return. So on a periodic basis, I will review whether this portfolio is giving me 12% return or not. If not, which of the asset, right, is giving me lesser return as compared to the other assets. So I would like to change those assets which are giving me lesser return, or which is I am even expecting that in future also I am not expecting much from it. So I may like to get rid of those assets and would like to invest in those securities where I can give better return. And lastly, I can say it can be done using absolute return as well as various risk adjusted return. Absolute return means in terms of amount, or it may be in terms of percentage. So there are various tools. I am not discussing those tools, and ratios. So we call it Sharpe ratio, Trenner ratio, Jensen alpha. So these are the various techniques, various tools by which you analyze your portfolio performance. And finally, portfolio revision. When I talk of portfolio revision, means that on the basis of portfolio evaluation, as I just said in the previous point, that those asset class or those securities which are not performing well, you will have to replace it. Like if I talk of suppose equity portfolio, I have an equity portfolio of say 1 crore rupees. Within that equity portfolio, some of the shares may not be performing well. Say for example, if I'm invested in say steel industry, and if the steel industry is not doing well internationally, means the steel prices are low, because these are all commodity market, these are all cyclical industry. So at a time when internationally the steel prices are low, all those companies which are in the manufacturing of steel, they don't perform well in the equity market. And you are expecting that this cycle has reversed, and over a period of time, 4-5 years, it will remain at a low level. So you would like to exit from the shares, from the equity of the steel industry, and you would like to buy those shares which are in a booming industry, where you feel that this industry will boom in the next coming 4-5 years. So you like to replace the shares of that industry which is not performing well with the shares of those industries or that industry which is doing well. So this is called portfolio revision. So as time, and over regular intervals, when you evaluate your portfolio, then you would like to revise it and change according to your need, according to time, according to environment. So this is all called investment decision process. Thank you.